Is it true that you should avoid stocks during an election year? Fact or fiction? Welcome back to the Motivated Investor. Today, we're diving into a topic that's often debated among investors. Should you really avoid stocks during an election year? Is this a smart strategy or just a myth? Let's break it down and find out what the facts really say. Election years can bring about a lot of uncertainty. With candidates campaigning, debates heating up, and policies being discussed, but the stock market often reacts to the political climate. This leads many investors to wonder if they should steer clear of stocks during this time. But is that the right approach? First, let's look at the historical perspective. There have been many election years where the stock market performed well, and others where it didn't. While some studies suggest that markets can be more volatile during election years, it's essential to consider the bigger picture. The stock market is influenced by many factors, including economic conditions, interest rates, and global events, not just the political landscape. Many investors believe that avoiding stocks during an election year is a form of risk management. They think that by stepping aside, they can protect their investments from potential dips caused by political uncertainty. However, this mindset can lead to missed opportunities. Historically, some of the best days in the market have occurred during or immediately after elections. By staying out of the market, you might miss significant gains. Another point to consider is the type of election. Presidential elections may have a different impact on the market than midterm elections. For example, historically, the stock market tends to perform well in the years following a presidential election, regardless of which party wins. This is due to the market's tendency to rally on clarity and stability that follows the election process. Now, let's talk about strategy. Instead of avoiding stocks altogether, consider a more nuanced approach. Diversification is key. By having a well-rounded portfolio, you can mitigate some of the risks associated with election year volatility. Focus on sectors that historically perform well during election years, such as healthcare or consumer staples. These sectors often remain resilient regardless of political changes. It's also crucial to remember that long-term investing is typically more rewarding than trying to time the market. If you believe in the companies you're investing in and their long-term potential, short-term fluctuations caused by elections may not significantly impact your overall investment strategy. As we wrap up, the idea that you should avoid stocks during an election year is more fiction than fact. While it's essential to be aware of potential volatility, completely stepping away from the market could mean missing out on valuable opportunities. Instead, stay informed, be strategic, and focus on your long-term goals. Thank you for watching this episode of The Motivated Investor. If you found this information helpful, please give us a thumbs up and subscribe to our channel for more insightful content. We appreciate your support, and we look forward to seeing you in the next video.